Every piece of financial advice you grew up with points in the same direction. Debt is bad. Debt is dangerous. Debt is something you escape from, not something you run toward. Pay it off as fast as you can. Cut the cards. Never borrow what you don't need. And for regular people living regular lives, that advice is mostly right. High-interest credit card debt, payday loans, car loans on depreciating vehicles. Yeah, avoid all of that. But here's the part they left out. The wealthiest people in the world don't avoid debt. They use it, deliberately, strategically, in ways that are almost completely backward from how most people think about borrowing money. And the gap between how broke people use debt and how wealthy people use debt isn't just a matter of scale. It's a completely different mindset about what debt actually is. Most people experience debt as a consequence of not having enough money. The car broke down, the card went out, the medical bill arrived. Debt is what happens when life outpaces income. Wealthy people experience debt as a tool. Same word, completely different relationship with it. So let's go through the 6 ways rich people actually use debt to build more wealth. Because once you understand the logic, you'll start seeing money in a fundamentally different way. Way 1. They borrow to buy assets that pay them back. This is the foundation of almost everything else on this list. A wealthy person doesn't borrow money to buy things that lose value. They borrow to buy things that generate income. The most obvious example is real estate. An investor puts down a portion of a property's price, borrows the rest from a bank, and then rents that property to tenants. The tenant's rent covers a mortgage payment, and ideally, more than covers it. So the investor is using the bank's money to own an asset, and the asset is paying off the bank's loan while the investor collects the difference. They didn't need to own the property outright. They just needed enough for the down payment. The debt did the rest of the work. Way 2. They use other people's money to multiply their own. This concept has a formal name, leverage, but the story version is simpler. Imagine you have $50,000. You could buy one small investment outright and wait for it to grow. Or you could use that $50,000 as a down payment on a much larger investment, control something worth several times what you put in, and benefit from the growth on the whole thing, not just your slice. That's what leverage does. It multiplies the surface area of your money. The risk is real. Leverage cuts both ways. But wealthy people understand that the right debt in the right situation doesn't just add to their returns. It multiplies them. Way 3. They use low-interest debt to keep high-return investments working. Here's one that sounds counterintuitive until you see the logic. Say someone has $1 million invested in the market, producing a consistent return year after year. A major expense comes up, a business opportunity, a renovation, something significant. The average person would sell their investments to cover it. The wealthy person takes out a loan at a low interest rate instead. Why? Because if their investments are growing faster than the cost of the loan, selling would actually cost them money. The debt is cheaper than the opportunity they give up by liquidating. They're essentially paying a small fee to keep a larger machine running. Most people never think about debt this way because most people don't have investments big enough to make this trade worth it. But the mindset applies at every scale. The question is always whether your money is working harder than your debt costs you. Way 4. They borrow against assets to avoid taxes, legally. This one surprises people every time. When you sell an investment that has grown in value, you pay capital gains tax on the profit. But if you borrow against that investment instead of selling it, you don't trigger a taxable event. You get access to the cash, you keep the asset, and the loan isn't income, so it isn't taxed. Wealthy people, particularly at the highest levels, have used this strategy for decades. They accumulate assets, borrow against them at low rates, use the cash to fund their lifestyles or new investments, and let the assets continue to grow untouched. The debt isn't a burden. It's a tax management tool. This is a more advanced strategy and the details matter, but understanding that debt can be used to defer or avoid taxes is a completely different frame than most people ever encounter. Way 5. They use business debt to build things that outlast a loan. When a business takes on debt to expand, to open a new location, hire more people, buy better equipment, the goal is that what gets built generates more than what was borrowed. A restaurant owner takes a loan to open a second location. If that second location becomes profitable, the loan was just the cost of entry into a larger revenue stream. The debt has a fixed end date. The income stream, ideally, doesn't. This is how businesses scale without waiting to accumulate enough cash organically, which could take years and cost them the window of opportunity entirely. The loan is a bet that what gets built will pay for itself and then keep going. Wealthy business owners are comfortable making that bet because they've learned to evaluate it clearly. Way 6. They use debt to stay liquid and keep options open. Liquidity, having accessible cash, is one of the most underrated advantages in personal finance. Wealthy people often maintain lines of credit not because they need the money right now, but because having access to capital quickly means they can move when opportunities appear. A property comes available below market value. A business needs a fast investor. A deal has a short window. The person with a line of credit can act. The person without one has to watch. Debt used this way isn't about spending. It's about being ready. It's about keeping the door open so that when the right moment comes, you're not standing outside it wondering what might have been. Now look, I want to be direct about something. None of these strategies are risk-free. Leverage can amplify losses just as fast as it amplifies gains. Business debt can bury a company that misreads the market. Borrowing against investments carries real consequences if those assets drop in value. Wealthy people who use debt well do so because they understand the risk clearly, not because they are gambling recklessly. The mindset shift isn't debt is good. It's debt is a tool, and tools can be used well badly. A hammer can build a house or smash a thumb. The hammer isn't the problem. The skill of the person holding it is what matters. Here's the thing that nobody teaches you growing up. The financial education most people receive is built around one goal: keep you out of trouble. Don't overspend. Don't borrow more than you can pay back. Stay safe. And that's genuinely important. But it stops well short of the other half of the conversation, which is how money can actually work for you, not just against you. The wealthy didn't get there by following the same rules as everyone else. They learned a different set of rules, ones that treat debt not as an emergency to be avoided, but as a lever to be positioned correctly. You don't have to be wealthy to start thinking this way. You just have to change the question you're asking about debt. Instead of, how do I get out of this? Start asking, is this debt working for me, or am I working for it? That one question, asked honestly and regularly, will change where every dollar you borrow ends up. Debt in the wrong hands is a trap. Debt in the right hands is a blueprint. Now you know the blueprint.